So there's a particular kind of market update that circulates every spring, the one that finds the most dramatic number of the week and leads with it. Supply is up 13%, prices are up 7%, and it's not exactly wrong. Those numbers exist, but they are a weather report, not a climate forecast. And in real estate, the climate is what determines your outcome. The weather just gives you something to talk about at the open house. I'm Perreault, Managing Principal Broker at 5 Realty. I'm licensed in Oregon and Washington and California. I have 21 plus years in this business, and before all of that, I spent years doing process engineering improvement in aerospace manufacturing. And when you build systems like that have to perform consistently under variable conditions, I helped build the F-18s. I love those planes. You develop an allergy to single point measurements. What matters is the trend, the sustained direction, the signal underneath the noise. That is the system I brought to real estate, and it is the foundation of everything you'll hear today. Before we get into the numbers, let me explain the tool I use to find that signal. It's called a rolling average, and it is borrowed directly from my engineering background. Every week, I take the most recent 12 weeks of data for any metric I'm tracking. Homes sold, active listings, new pending contracts, whatever. I add all 12 values together and then divide by 12. Tricky, huh? That's my rolling average for the week. The next week, I drop the oldest data point off the back, add the newest one to the front, do it all over again. The window moves forward in time, always covering the most recent 12 weeks. But what I also do is take the 12 weeks from a year ago and keep moving that window forward too. So we're always comparing the same window, not just the same week, to really be able to develop trends. So what this does is absorb the distortions. The holiday week when nobody lists anything, the week of a major storm, the fluke week when a cluster of luxury properties all close at once and inflate the average sale price. All of that noise gets diluted across 12 data points, and what's left is the underlying momentum. More importantly, when the trend starts to change, the rolling average shows me that change early, before it becomes obvious in any single week's headline. That's the early warning system. Okay, let's get into it. So this data covers market activity for the week of March 2nd through March 8th, 2026 across Washington, Multnomah, and Clackamas counties in Oregon and Clark County in Washington. So let's start with the cost of money. The on-point federal credit union rates that were effective on March 10th, 2026 for a 30-year fixed was 5.875% and a quarter point with an APR of 5.925%. That's a quarter point above where rates had been parked for the prior 3 consecutive weeks at 5.625%. The rate for a 30-year fixed had risen to 6%, with half a point for an APR of 6.101%. Of course, this is a market reaction to the conflict in Iran. It may be a short-term blip, but if hostilities keep up, we may see even higher rates. So if you're in the market to buy a home, get it in gear, and I'm happy to help you with that. I've been tracking rates in the historical file for 4 weeks now, so I cannot yet calculate a 12-week rolling rate average. I need 8 more weeks, 8 more data points before that picture becomes truly meaningful. What I can tell you is the direction this week is up. 1 week is not a trend, but after 3 steady weeks, a move higher heading into the spring market opening is worth flagging for you. In dollar terms, on a $595,000 purchase, our current median sales price with a 20% down payment, the difference between 5.625% and 5.875% is approximately $82 per month, about $29,500 over the life of the loan. Real money, but not a number that appears to have stopped buyers this week, as we will see in the demand data. The key question over the coming weeks is whether this is a directional shift or a 1-week blip, and we will know more once the data catches up. The headline numbers for this week: 449 homes were sold. Average days on the market were 75, the median was 30. The average sale price, $676,868, and the median sales price was $595,000. Read in isolation, those numbers look like a market in robust spring acceleration, but some of those headlines comparisons are optical illusions produced by single-week data, and I want to work through each carefully so you leave here with an accurate picture rather than a flattering one. So 12-week rolling average, current versus same period last year, 5,681 active, that's up 10% year over year compared to 5,134 was the rolling average last year. The new pending is up 8% versus the year over year 469. The new listings are up 22% versus year over year 386, and that's 3.8 months. Homes sold with a rolling average is essentially flat versus the year over year 370. It was 371 this year. Homes sold with a rolling average was 371 this year and was 370 activity last year, so it's essentially flat. So let's look at the supply. 5,936 active listings in the Portland Metro and Clark County market. On a rolling 12-week basis, the average is 5,681, up 10.7% from the same rolling window last year at 5,134. More supply than a year ago. It gives buyers more choices. That's a fact, but here's the context that matters. This market hit a peak of 8,625 active listings roughly 9 months ago. We have been drawing down from that peak ever since. What's happening now is the normal spring replenishment. Sellers who held throughout the winter are entering the market as buyer activity picks up. 725 new listings came to market this week compared to 656 in the same week last year. That's a 10.5% year-over-year increase, a measured proportional spring ramp, not a flood of distressed or desperate inventory. The faucet turned up, but not dramatically. The rolling 12-week new listings average is 471 per week compared to 386 at the same point last year. That's a 22.1% rolling year-over-year increase. Supply is coming in faster on a sustained basis than it was a year ago. That's what these numbers are telling us. That structural shift is what pushed months of supply from 3.5 months a year ago to 3.8 months today. Still a balanced market, still well under the 6-month threshold where we would call it a buyer's market. But the balance has shifted incrementally, and that incremental shift has real implications for pricing strategy, which we will get to. Now to demand, and this is the more encouraging side of the ledger. 660 new pending contracts were written this week compared to 626 during the same week last year, a 5.4% year-over-year increase at the spot level. Total pending sales reached 2,996, up 11.5% from 2,687 at the same time last year, and the highest we've seen in 2026 so far. The pipeline is building. The rolling 12-week average for new pending contracts is 507 per week versus 469 per week in the same rolling window last year. That's only an 8% sustained year-over-year increase in buyer engagement. So buyers are not sitting this out. They adapted to the new rate environment, recalibrated their expectations, and are writing contracts at a pace that consistently exceeds last year. That's not a fragile demand picture. That's a market where buyers have found their footing and sellers are pricing more correctly, and everybody has to give a little in order to get a proper contract negotiated. It's not win for the buyers, it's not win for the sellers, it has to be win-win. The dynamic to understand is the relationship between supply growth and demand growth. On a rolling basis, new listings are up 22.1% year over year. New pending is up 8%. Supply is growing faster than demand. That's why months of supply has nudged up from 3.5 to 3.8. Think of the supply side as a treadmill and the demand side as the runner keeping pace. Last year, both were running at roughly the same speed. This year, the treadmill moved up a notch. The runner is keeping up, but working a little harder to do it. The homes that are priced correctly are still selling. The ones priced ahead of the market are accumulating days instead of contracts. We've talked about this before. You have to hit the number correctly in the beginning in order to take advantage of that momentum that you have in the first couple of weeks. Homes sold this week were 449 versus 462 during the same week last year. That's a 2.8% decline year over year at the spot level. On the rolling 12-week basis, closings are essentially flat, 371 per week now versus 376 last year. The volume of transactions being completed is holding steady. The market is not contracting. It is absorbing more supply at roughly the same transaction pace as last year, which is mechanically why months of supply has risen slightly. So let's talk about price. The average sale price this week was $676,868, up 7.2% from $631,664 a year ago. The median was $595,000, up 5.3% from $565,000 a year ago. Both of those are spot figures for this week and 1 week ago, 1 week a year ago. So here's what the rolling 12-week average tells you. Average price rolling is $610,174, up 10% from $604,429 a year ago, and the rolling median is $548,176, essentially flat versus $547,923 last year. This week happened to close a cohort of higher price transactions. The underlying sustained price trend is stability, not appreciation. Sellers pricing from this week's average are using the wrong ruler. The sale to list ratio data is arguably the most strategically important signal in this week's report. Average sale price came in at 98.52% of the asking price at the time of sale. Buyers paid 1.48% below asking on average. Last year, year, that ratio was 99.37. Buyers are negotiating more. But the original list price figure is the number with Realty. Homes sold for 95.35% of their original list price on average versus 96.46% a year ago. That's a sign that the people had to reduce their prices. The trajectory from original list to final close price has widened by about 1.1 percentage points. On a 595,000 home, that is approximately 6,500 that sellers who overprice and reduce are leaving on the table compared to sellers who price correctly from day one. And the single number that captures the full shift in negotiating posture better than any other, the median sale to list ratio was 102.71% this time last year. This week it is 98.35%. So the 102.71% means people were paying over average on the median. Now it's 98.35%. They're paying less than the asking price. So the typical seller at the median price point last year was receiving offers above their asking price. The typical seller this spring is accepting a little below. That's not a crash, it's a recalibration. But sellers who enter this market with 2024's assumptions will encounter 2026's reality, and those two things are not the same. Days on market, the average is 75, the median 30. Average days on market is up 21% from 62 last year. Median is up 15% from 26. But the gap between 75 and 30 is the real story. When a mean is that much higher than the median, it means a long tail of slow-moving properties is distorting the average. There is a cohort of homes that were listed last fall at above market prices, went through multiple reductions over months, and are only now finally closing. They are pulling the average up substantially. The median of 30 tells you what a correctly priced new listing in March 2026 can actually expect. Half of all homes that sold this week did so in 30 days or less. That's an active market. The trend inside the median days on market is worth noting. The rolling 12-week median was at 66 days as recently as February 1st. It's 30 days this week. That kind of drop in the median across a few weeks is a textbook spring acceleration pattern. The stale winter inventory is clearing out. Fresh spring listings are moving quickly. The seasonal pivot happened on schedule, possibly slightly early, which aligns with the above-trend new listing activity we are seeing in early March. And I think everybody realizes that our weather's been really nice this year. Worried a little bit about drought, but it's been very, very mild winter. That probably helps. 583 price reductions in the past 7 days, 262 of them were 15,000 or more. As a share of active listings, that's 9.8%, up modestly from approximately 9.3% last year. The bumpable contingency, bumpable means they're under contract, but the people have a contingency to sell their house, and if somebody comes along with an offer that doesn't have a contingency, they can possibly bump the first buyers out of position. So that is down from 75, down from recent highs near 120. A mild positive suggesting accepted contracts are more stable than they were a few months ago. Basically, sellers are not so willing to accept a contingent offer because they want certainty, and so the number of bumpables is going down. Implications by position. For sellers, you're entering the spring market at its peak buyer activity point of the year. 2,996 homes under contract, the highest of this year. New pending up 5.4% year over year. But this is not a market that rewards overpricing. The original list to close ratio has widened. The median buyer is no longer above asking price. The sellers winning this spring are the ones who price to attract showings in the first 2 weeks and close at or near their ask without reductions. The sellers losing are the ones pricing aspirationally, leaving money to negotiate with, and they're sitting 60 to 90 days, ending up taking reductions and ending up well below where they started, and in my opinion, well below what they would have gotten if they priced correctly in the first place. The math consistently favors precision pricing from day one. For buyers, more inventory than a year ago, 5,936 active listings versus 5,249, a 13.1% increase in your options. The typical seller is accepting below asking. The average home closes at 95.35% of original list. That negotiating room is real, and it's larger than it has been in years. Rates moved up this week, but 660 buyers wrote contracts. This market is not paralyzed. If you've been waiting for a better entry point, the data suggests this spring offers more favorable buyer conditions than any market since at least 2019. For move-up households, 3.8 months of supply is one of the more more workable environments for this transaction type in recent memory. You're not rushing to sell in a frenzy and overpay in the same frenzy. Both sides of your transaction carry rational, predictable expectations. Your equity position is intact. Rolling prices are flat year over year, not declining. For downsizers and retirement transition households, equity is strong, spring buyer demand is at its annual peak, and the window between now and Memorial Day is historically the most active buyer period of the year. If transition is on your timeline, the conditions are in place. The complete picture: an orderly, balanced spring market. Supply up modestly year over year, demand also up but at a slower rate. Months of supply at 3.8%, slightly more buyer favorable than last year, but firmly in balanced territory. Prices are stable on a rolling basis. The spring acceleration is real in the days on market data. Rates ticked up but have not stopped buyers. The sellers who succeed this spring are the ones who price from the rolling average, not the weekly headlines. The buyers who succeed are the ones who show up prepared and move with conviction when the right home appears. So I run this analysis every single week because the market rewards the people who understand it. If you want to be one of those people, subscribe so you don't miss the week the trend turns. The full written analysis is at pdxhomesforsale.com, my blog. And are you ready to talk strategy? Lauren at pdxhomesforsale.com or 503-683-1885. See you next week.